Thank you for joining us on another episode of the Bamboo Stock Market course. Today we are going to be talking about ETFs. What are they and why are they so popular among beginners?
Not just beginners, even big shot investors like Warren Buffett love to invest in ETFs. An ETF is also called an exchange-traded fund, and they're a type of investment that act like a mutual fund, but they can be traded on the stock markets. An ETF can track a particular index, sector, commodity, or asset.
So when you say track, index, what do these terms mean?
Well, a market index follows the movement of a certain group of stocks. An example is the S&P 500. This index follows the 500 biggest companies across the US stock markets.
So guys, remember, we just spoke about the S&P 500, so it's gonna keep coming up. And the S&P 500 has an ETF that basically tracks the top 500 stocks in the US. So ETF tracking, what does that mean? That basically means that the share price of the ETF will move as the share prices of the various companies in that ETF move. So remember we spoke about the S&P 500
Yes.
ETF, exactly. The ETF that tracks the S&P 500 index will basically move as the share prices of those 500 companies move. So as those 500 companies, if the stock prices of those companies are going up, the price of that ETF will also go up. And if the stock price of those 500 companies are going down, the price of that ETF will go down.
That makes a lot of sense. So is that kind of like getting a lot but for the price of one then?
Exactly. So when you buy the ETF, you basically get exposure to all the companies that are in that ETF. So if you buy an S&P 500 ETF, you're basically buying a little bit of the top 500 companies in the US stock markets.
Okay, so is it only sectors or companies that I can invest in via ETFs?
Nope. There are many types of ETFs that cover the length and breadth of the US stock market, right?
Exactly. There are ETFs that focus on bonds, for example, or there are also ETFs that focus on stocks, like we've been talking about. So those are your traditional ETFs. You also have ETFs that give you access to a specific sector or industry. So think about it. You want to start investing in the stock market and you don't know what to buy, but you're like, I like the tech industry and I want to invest in the tech industry. Or I like the healthcare industry and I want to invest in the healthcare industry. You can literally go on Bamboo and just search for ETFs that have to do with tech or ETFs that have to do with healthcare and just buy that. So you get exposure to the entire industry. So you don't have to now start thinking, okay, this is the good company or this is the bad company. You just are like, I'm investing in the whole industry.
That's mad.
Yep. And commodity ETFs invest in commodities such as crude oil, for example. Holding shares in a commodity ETF is cheaper than an actual physical possession of the commodity. Plus, it's a good way to diversify that portfolio. There are also currency ETFs that track the price of global currencies such as the US dollar. And finally, we have inverse ETFs that basically reverse your OG ETF. You get it?
I'm not following. Please explain.
Okay, wait, think about this, right? When you buy a regular ETF, you're hoping that the price of whatever is in that ETF goes up so that you also make money. But with an inverse ETF, when the price of the index that the ETF is tracking goes down, that's when you make money. So let's say you think the stock market is going to tank. What you do is you buy an inverse ETF so that when the stock market goes down, you'll go up and you'll make money.
Take note, because I'm learning so much about ETFs right now, and I'm planning to add a gold ETF and an SPDR to my portfolio with immediate effect.
Oh, yes.
There's so much more to investing than buying and holding. So next up, we'll be discussing the 4 main investment strategies.